Okay, this week I want to start with at least parts of the economic calendar because the thing that moved the markets this past week uh, were the job reports. Now, rarely have I seen the JOLTS report move the market, but when it came in on Tuesday, and we just take a look here at the calendar, on Tuesday at 10 a.m. with an 8.827 million openings. That moved the markets immediately. I was watching the SPY at that point, and the SPY just shot up and led to actually a pretty good week in the markets. And obviously, the influence there is that the Fed uh, wouldn't raise rates, um, based off of a weak employment print. And then today, on Friday, the unemployment rate came out in at 3.8%, and which was higher than the consensus of 3.5% in what was reported in the previous period. But the non-farm payrolls were 187,000. Expectation was 170. Here we have a forecast of 180,000, but was up from the previous month. But here's the kicker: there's a couple of things that have been talked about. One is the quality of three things. One is the quality of the jobs that are available in the market. They're mostly service types of jobs. So most likely lower end, but nobody really tracks it in that fashion. The second one that came out and has been talked about for quite a while is that for every job posting, or for every job, that there are 3 job postings because for a while there we had problems with trying to get people to work, to go to work. And so that was the second thing that has been talked about. But here is the real kicker. You look on CNBC, and when they reported this morning the jobs number of 187,000, just look at this. And this has been going on. They moved the July estimate moved down by 30,000 to 157,000. And then the June was revised lower by 80,000 to 105,000. So we're over reporting these each time they come out. Market reacts to it, and it gives the Fed, unless they know something we don't know, which is possible, that 105,000 jobs, lowering that, excuse me, by 80,000. That is just an incredible amount of revision that's going on month to month here. So the jobs outlook, the jobs and the way that they're being reported with these large revisions is really just I've never seen revisions like this come to non-farm payroll like we're seeing now. So something needs to they need to tighten it up or something, because a lot of decisions are based off of this. It is a lagging measure, but still, revising down by 80,000 to 105,000 in June. People are thinking, oh, we had 185,000 jobs. No, you had 105,000. So anyway, this is the type of thing that we have going on in our government at the moment reporting. So back to the economic calendar. Let's look at some of the other things that happened this week. So with Dallas manufacturing on Monday was down 17.2%. Mortgage rates stayed steady, still elevated at 7.31%. This number is headed towards 8%. I'm curious to see what happens. Now, another kind of market mover was GDP growth rate. It was expected to be 2.4% on the estimate, and it came in at 2.1. So Wednesday had quite a few things that were going on that were moving the markets. And other than, like I said, Tuesday at 10 a.m., boom, that really affected things. And Thursday, it was really anticipating. This was the thing I was looking for the most for this week was the PCE, the core PCE print. 0.2% was in line, didn't really, upset the market, didn't move it forward or anything like that. So pretty much all of the inflation indicators that the Fed watches came in line with what the expectations were. And then Friday, today, the unemployment rate came in at higher at 3.8%. Non-farm payrolls, which I just talked about. So it's interesting what's happening here. I don't know. Are things being manipulated as far as the non-farm payrolls? Who knows? But these revisions are huge. I mean, somebody giving you those types of estimates, you really don't want them to estimate anything for you. Taking a look at next week, there's not much. Obviously, Tuesday is Labor Day, and there's I don't know what happened just then, but let's get all these countries off of here. I have no idea what's going on here. It'll take me a second to. This week we'll go to next week. Look at the countries. There we go. Let me clear these out and get just the U.S. up here again. I don't know why that never had to happen to me before. Okay, on Tuesday next week, we'll have really not much. There's nothing there that's going to move markets anyway, or not expected to. Wednesday, we'll obviously get the mortgage rate. And then some of these S&P PMI levels we're expecting to go down. Now, this potentially could move the market on Wednesday. These services numbers are expected, to start contracting. In other words, a prints of less than 50. So we'll have to see how they come out on Wednesday. We have initial jobless claims. So, not a lot of economic reporting going on next week that's going to be market movers, but things happen during the week, and different things happens, but no real expectation. The trend has been when things have been quiet that the markets have moved up. Okay, let's look at the individual markets, starting with the Dow, and these are weekly data. And the Dow obviously was up for the week. Was a pretty good week. We want to get excited about something, we can start to get over 35,667-ish, 35,675, somewhere in there. Then we've got a higher high that's coming out. We've got a higher low. Now we need that higher high to start to develop over the next week or two. And then the SPY started its turnaround, again, weekly data. The volume's been pretty average, maybe a little less than average. But, what you're also seeing on here is the 18 and the 40 moving averages, just kind of one of many moving averages that I actually use. But again, higher low, right? On the weekly, higher low here. We need to print something, a higher high over 459.60 before we start to make our way back down. Like to see it actually, this run, take us close to this 480 mark. I think the number is 481.18 or something like that on the SPY. The Qs, again, a good week. These are weekly data. We've now got a higher low. We're moving, from a structural standpoint on the pricing. We need to clear 387 or 388 ish to get a higher high before we start to make our way down. I'd like to see it go ahead and just finish this thing off, at 409. That would be expectation. There's still a lot of bears out there thinking that this is it, that it's going to roll over from here. So it's something to kind of keep in mind. And I'm going to talk about at the end here, starting to think about something called a tail hedge, which we'll talk about here at the end. The IWM made a nice recovery this week, but as most people said, we need to get above 200 or even 202 here in order for the IWM, the Russell, to make its move up. The 10-year, again, we hit up here on the yield at 4.33 last week. This week it came down a little bit but recovered. We need this to continue down. And change the color here real quick. We have different support levels, but this probably could get moved up around in here now. Let's see what else we got. The dollar. I've got these areas. I thought maybe we'd start to make our way down. It looked that way. And again, weekly data. Just to take a look at the daily. We started to make our way down at the beginning part of the week, and I thought we'd make it down to this other level of support here around 101,675, but we pop back up. Now we get a double top here on the weekly. Yeah, right there, or multiple tops. Once they start hitting that many times, though, a lot of times it may go up and it may hit this area, up in the 105 area. But it's not rolling over. And we'll talk about David Hunter and Peter Schiff here in a minute too. The crude oil has now broken through. Now we need a confirmation week or day in order to say that crude oil is going up above 85. Our next spot would probably be somewhere around this area where we'll get some resistance, and that would be around 92.50. And again, David Hunter's expectation is this thing should start to make its way towards 60. Now it's longer term, but if it starts up on here and doesn't meet some resistance somewhere, there's other little places here, maybe around 88. But let's see if this gets confirmed next week and or starts to roll itself down. Okay, the VIX continues to get crushed downward. Looking at the daily, the weekly, you can see, with all this, these are signs of a bull market, which we really are in at this point, but we have not been able to recover much in the way of the breadth of stocks getting over their 200-day average. I don't know how, I believe it's important longer term that it catches up and there can be leaders in it. So far we've had like NVIDIA and Apple and some of those. Apple kind of collapsed. NVIDIA did for a while, but it's pretty well recovered, although today they had a bad day. So anyway, that's a look at the markets from this week. And let's take a look at the Truflation here real quick. We've actually been in an uptrend, based on these numbers. Government's reporting 3.2%, Truflation 2.67%, so there's a little less than a half a percentage difference. See if anything's moving down compared to a week ago. We're up 0.5% in housing, transport, Transportation is trending up a little bit. Utilities not moving. Health. So basically, we do have some movement upwards in the Truflation number, where it's been as low as 2%. Now, if that persists, that leads to our conversation about Peter Schiff and David Hunter. As far as the markets go, I would say, David Hunter is looking pretty good. We've had a bit of a recovery here. It started up. I thought maybe we make it up here. Will this be the push? Well, first we got to get over 35,680-ish in order for the markets to continue up, to get that higher high, from a structural standpoint. And, my expectation would be with this push, again, that we would get to near the all-time highs. Despite all the stuff that's going on with interest rates and everything else, the market has been resilient in that fashion. And that favors David Hunter. The crude oil is not favoring him, at least at the moment. Now, this is weekly data again, and his expectations is go down. Peter Schiff's expecting this to go up. The other thing that's going to be a headwind to the markets, at least I believe, is going to be if we don't get the dollar to start making its way down, which I thought it started to this week, and then it really gained steam the last couple of days. And it's 2 days. It's not super long term looking. I'm just curious here on the dollar, a monthly. Yeah, there's just kind of stuck in this range here between 101 and 104. It's if it really breaks through there, 105 maybe if we go back a few months. But this thing needs to roll down to help with inflation and help out David Hunter's forecast for deflation. That continues to go up, then that's going to be a headwind to the markets. Okay, so that's kind of a brief comment about that. Tailing hedge. One of the things, if you go back, and I went to Wikipedia and was asking, what are the largest daily percentage losses ever? So in 1987, the markets were down 22.6% in one day. And then the closest thing to that was back during COVID on March 16th, 2020, where it went down almost 13%. And then you have to go back to the Black Monday, type of crash, where you saw 12% on one day. Next day it went down by almost 12% the next day. So that kind of gives you a sense of, if things started to collapse quickly, what do you do? And these are some of the things that, as a normal investor, you're really not gonna talk about that often, because they are things that you don't have the tools available to you. But I'm suggesting, I'm not making trading calls or anything like that, but you can, in essence, buy puts, out in time to protect your portfolio. So, if with all the talk, Peter Schiff and David Hunter both are expecting, market crashes in 2024. Sometime, we start into the recession, and then the market starts to get into a bear market. And, let's say that you'd like to kind of cover yourself. Well, you can buy puts, for next June that are, we're at 451 now. It costs you $6. This would be $6 per contract. A contract is 100 shares, and you could buy that contract to kind of protect yourself. So if the market did crash and it went down to 375, that you would, in essence, you know, if for instance, and these are just going to be real rough, but if down 75 was up 75, you know, at some future date, you know, this is going to be horrible as far as the, you know, trying to get the exact amount. But you know, you can get upwards if it happened tomorrow. You know, it would be, you get $75 per share versus the 6, that would be $69 for that put, or $75 for that put, minus the $6 that you paid to get it. $69 times 100, times 10 is 690, is $6,900 when you bought a put for $6. Now, it depends on when the crash would happen and a number of other things, and that would be the best case scenario, you know, that you would get, that you immediately get the money back because the time value would start to eat away at it. But you can look at these things. You know, there's all types of websites out there, you know, for options, and you don't have to commit a lot. This is one, like I said, one contract. Maybe think, you know, maybe a good idea to have something to protect your portfolio. Then that would be a way to do it. Or you could buy, you know, if you bought 10 contracts, well, that would be $6,000. So just to kind of give you a sense, it'd be roughly $6,000 for these buying these puts at 375. And again, that would be the expectation if the market went down. And I wouldn't suggest starting with $6,000. As a matter of fact, I'm not making any trading calls, but I just want to open people's minds from an educational standpoint. There is a way that there are ways to protect your portfolio with puts. If, for instance, we did get a 20% crash, and actually that would even go down further. 20% would roughly put us at a $5 contract. But you can, you could do this, and it doesn't necessarily, you can still gain if the market goes down a little bit, as long as you have a lot of time on your side. And that's one of the things that makes options, either wonderful tools or terrible tools. So anyway, this is called a tailing hedge, and I like the idea of it, just to protect in case the market starts to go down. You have a hedge against something in the future. So yeah, this week, just one final comment, I guess, is it's not clear yet whether the inflation rate is going to continue on the way up, or where it's going to start to roll over. And if you're going to see, we kind of conflicting messages. Markets were up for the week. Crude oil was up, which is inflationary. The interest rates were going up, and that doesn't fit into David Hunter's deflationary forecast. But the markets are still going up despite the 10-year rates rising, which is something's got to give eventually. We'll have to see how it plays here for the two gurus and Peter Schiff expecting inflation takeover, and David Hunter kind of the deflationary force. So anyway, that's what I wanted to cover this week. And remember, there is always a better way.